Peter McGuire, CEO Exim.com, is here to throw some more light on that. Peter, what do you make of the move on crude owing to the Iraqi advance?
Well, good morning, and thanks for inviting me on the show. A couple of quick things. Yes, it's had a nice uptick over the last matter of, two trading sessions. No doubt a little bit of geopolitical was pushing it higher. US dollar came off a little, and I think that the bulls are certainly money managers and hedge funds, and of course producers are all saying it's a nice time to be in crude, and they're all long crude. So there's probably a little bit further uptick, and I wouldn't be surprised that, maybe put another dollar on Brent and WTI in the short term.
Right. Peter, what do you feel about the dollar index then? I mean, do you think that this brief blip that we've seen, a recovery from the lows of 91, the 91 level, is it for good, or is it just a flash in the pan and then we revert back? Because currently we are at around 93.2.
Well, I think it's what you've seen is a dead cat bounce. I think it'll probably continue its downdraft, but it does depend. Inflation's lower than we expected as far as Yellen was concerned, and what the great challenge is going to be if we do see a rate rise come December, then that's going to underpin the US dollar strength. But if you don't see one, I think you're probably going to see a 90 handle, maybe even a high 89 come February or March. So it might even happen by February. So the real push down is that the US dollar is going to either get sold off because inflation's low and if you don't see a rate rise, and they're the challenges. But there's a few other concerns that are also putting their head up, and we've just got to wait and see how the US stock market performs over the next, say, 4 to 6 weeks.
Right. Peter, I'll come back in terms of where crude is concerned. The next meeting in terms of where the OPEC is concerned is on the 30th of November. What do you think could be the expectation? Because earlier we have seen the agreement that has been extended till May for a period of almost 9 months until March 2018. And this was in a bid to go ahead and reduce the global oil inventories as support, oil prices. What do you think could be the expectation from 30th of November?
Well, I was at that meeting in May in Vienna, and I'll be attending the meeting next month in Vienna, the OPEC meeting. And I think what you'll probably see is a continuation from that March 31. You may see it roll out to June 30, and there's even talk. You could see it push all the way out for 2 quarters, out to September 30, next 2018. And there is crude overhang. There's still that production problems. And as you're seeing higher, what the interesting scenario is, as you're seeing more production coming out of the US, and of course the other side, as far as higher values, then that's going to, I think, probably have more shale producers entering the market, and I wouldn't be surprised to see a $10 million plus handle coming through as far as US production. So whilst the OPEC producers are looking at, cutting and trying to contain it through compliance, the US is going to be the wild card, and they're saying, well, they want to produce more, but at these sort of prices. So that's going to be, I think, a very fascinating trade over the next, 3 to 4 months, and what happens after November 30.
Right. Peter, just 2 questions. One question around the widening spread between WTI and Brent. We have seen over the last few weeks, in fact several weeks, that while actually the Brent actually has gained strength to strength towards $60, the spread between WTI and Brent basically has remained very high. And number 2, basically one factor would be why, and then again second factor would be what would be the implication on the currencies and also in terms of sentimental trading in Asia, because China's inflation number has come much higher than above expectations.
Well, first off, yes, I think it's certainly skewed to the upside as far as that Brent spread. No one would have thought you to be having a $6 premium, and the way it's travelling at the moment, that just seems to be widening week on week. So I think that you'll probably see, and we had some issues there as far as Brent production and, of course, refinery capacity coming out of the States. But overall, I think you'll probably continue at that $5 to $6 premium. In the short to medium term, it might narrow if you see some management closer to the mark as far as OPEC and what goes on with WTI. But and the next part, as far as inflation, it was better than expected in China. But the real driver is we just can't get inflation to really take off in Europe or in the US. Now, that's going to be the real handbrake, and that's where I think it's going to have a bit of a drive push to the downside as far as that US dollar. So that could actually make crude just that little bit better at the moment, better for the producers, and, of course, a better price point.
Right. Peter, one question around, I'm trying to get a global flavor from you here, is that the dollar basically, it actually fell after the inflation retail sales data came again. And then second point would be that on one side, you actually are seeing the US result season getting unfold. Number two would be that dollar basically at present trend actually is looking quite unclear. Base metal basically are looking very strong. And then again, the energy prices are also looking very strong. So what's the sense you are getting actually from the investors, and overall, how are the markets looking to you?
Well, from an investment standpoint, base metals energies have been a strong uptick really over the last, say, 4 to 5 weeks, and they'll probably continue in the short term. The unknown is, as we realise, as far as US dollar and what's happening there. If there is no, as I mentioned earlier, if there is no rate rise come December, then I think that's going to put further quick pressure to the downside as far as US dollar. I think it had a fairly strong bounce from that 90, 91 sort of level, and that's not unusual considering where it was this time last year. You know, it was around that 102, 103 level in the inauguration, or pardon me, at the election of President Trump. So, you know, it's been sold off very heavily, and that will probably continue. I think it's got the potential to take if no rate rises, probably an 88, by, say, late February, early March. But the reality of the matter is, from a trader's perspective, what's going on, there are so many big issues as far as inflation, as far as rate rises, and other geopolitical concerns, and what's happening with China as well. So all I'll say is this. It's an incredibly exciting time for traders, and the volatility is certainly their friend at the moment.